Welcome to vTalkInsight, Market Drivers Daily for May 21st, 2026. AI is no longer just a technology story. With a looming wave of giant IPOs, record capital spending, and rising bond yields, it is starting to reshape how equities, credit, and liquidity are priced. Let us begin with how the AI narrative itself is evolving beneath the headlines. The core AI story today is moving from excitement about potential to a tougher discussion about sustainability and capital intensity. Earlier this week, the focus was on whether Nvidia could meet sky-high expectations for earnings and guidance. Now that the company has delivered another huge revenue beat and raised its outlook, attention is turning to how durable this pace really is and what it means for the broader AI ecosystem. Across infrastructure, the AI build-out still looks like an arms race. Spending on AI data centers is described as potentially running between $4 and $5 trillion a year over time. Yet only a small fraction of that has been deployed so far, and corporate AI-related capital expenditure is already up around 50% year on year. At the same time, firms like Anthropic are doubling quarterly revenues to well over $10 billion. And OpenAI is preparing a confidential filing for what could become the largest stock market listing on record, ahead of rival offerings from Anthropic and SpaceX. On the ground, adoption is spreading but uneven. Major banks, such as JP Morgan and BNY Mellon, are embedding AI into core workflows, while planning for workforce shifts where some traditional middle and back-office roles shrink and demand for AI talent increases. Executives expect 7 to 8% of jobs to be affected over the next decade, particularly in administrative and software roles. Yet data so far show only a small share of layoffs formally attributed to AI, as many firms focus on retraining and redeployment. For the macro backdrop, AI is now part of the inflation and yield debate. Central bank officials see the long-term potential for AI-driven productivity to be disinflationary, but near-term, surging demand for chips, data centers, and energy is adding to price pressures and contributing to higher bond yields alongside large fiscal deficits. Some asset managers are tilting toward corporate credit over treasuries, viewing it as a way to gain exposure to AI-linked growth while retaining an inflation hedge, although treasuries could still act as protection if the AI capex cycle were to crack. Meanwhile, positioning in AI and tech-heavy markets such as the United States, Taiwan, and Korea is described as crowded, raising consensus risk if sentiment turns. Countering the worries, several forces still support a long runway for AI. Nvidia is expected to retain a dominant share of AI infrastructure for public cloud and enterprise workloads. Governments are rapidly scaling their own usage, and state support is expanding into adjacent areas, such as quantum computing, where firms like IBM are receiving large grants. Policymakers also believe the United States' lead over China in AI could widen due to better chips, talent, and protections against intellectual property theft. From here, key markers are how quickly OpenAI and Anthropic move ahead with their listings, what Nvidia reveals at upcoming events about markets like server CPUs and agentic AI, and how labor and inflation data reflect the early impact of this investment wave. All of that is feeding directly into how tech leadership shows up in equity markets. Equity performance remains heavily driven by technology and AI, but the pattern is becoming more selective. Nvidia just posted another exceptional quarter, with revenue growth above 80%, data center sales nearly doubling, and gross margins around 75%, while guiding second quarter revenue to roughly $91 billion, ahead of the average analyst forecast. Yet after a strong run into the print, the stock reaction has been muted, suggesting that even excellent numbers are now largely expected and near-term upside may require a fresh narrative beyond pure AI momentum. This dynamic is feeding concerns about concentration. Index gains are increasingly clustered in AI and tech, while sectors more exposed to higher inflation and energy costs are seeing downgrades and weaker price action. At the same time, leadership within technology itself is rotating. Hedge funds have been shifting AI exposure from United States chip names toward Asian manufacturers, helping drive an 8% surge in Korea's equity index after Nvidia's results, and Samsung's memory profits are jumping on AI server demand following the resolution of strike risks. Individual stock moves underline how sharply the market is differentiating between perceived winners and laggards. Enterprise software names like Workday and Zoom have been rewarded for earnings beats and higher guidance, while companies such as Intuit are being punished with double-digit declines on disappointing results and workforce cuts linked to AI disruption fears. On the upside, IBM has rallied strongly after securing roughly $1 billion in government support for quantum initiatives. An additional United States grant for a group of quantum firms are reinforcing investor interest in technologies seen as the next wave of computational power after current AI hardware. Valuation and liquidity questions are never far from the surface. Some investors now view Nvidia almost as a category of its own, arguing that its control of key supply chain bottlenecks justifies a higher long-term valuation, while others highlight that stock buybacks and a higher dividend are unlikely to drive incremental demand when most buyers are focused on growth. Excitement over prospective listings from OpenAI, Anthropic, and SpaceX is boosting fee expectations for United States banks, but also raises the prospect of a flood of new equity supply that could test available liquidity and risk appetite for other high-growth tech names. In parallel, demand is tilting from treasuries toward corporate credit as investors look to capture both yield and exposure to AI-driven stories, contributing to tighter spreads even as government bond yields remain elevated. Despite these tensions, the bull case for a tech-led rally is still grounded in earnings. Major Wall Street houses remain overweight equities, pointing to robust profit growth and persistent enthusiasm for AI, and upgrades to S&P 500 targets are being justified by stronger margins and sales at large technology platforms. There are also signs of breadth improving around the theme, with industrial automation names tied to AI and robotics seeing order backlogs far above long-run averages. From here, key signposts include how Nvidia trades around important technical ranges, whether Asian tech outperformance continues, how quickly the mega IPO calendar fills, and whether future earnings beats in software are rewarded or increasingly faded. Behind these market moves lies a deeper question about how much genuine growth is being created by the AI and technology capex boom. Beneath the price action, there are clear signs that AI and adjacent technologies are acting as powerful growth engines, even as they demand enormous capital. The global AI infrastructure market is described as supply-constrained, with companies racing to expand data center capacity and corporate AI-related capital expenditure up by about 50% over the past year. Nvidia's latest results, with data center revenue nearly doubling in guidance at the high end of expectations, are reinforcing optimism for suppliers across the hardware chain, while industrial firms exposed to automation, such as factory equipment and testing specialists, report order backlogs running many times their long-term averages. Growth acceleration is also visible in space and quantum, which are increasingly framed as derivative plays on AI. SpaceX is already generating substantial recurring income from data center capacity and satellite broadband, with revenue from these lines running into the tens of billions of dollars annually, even as heavy investment in AI and its Starship launch system is depressing near-term profitability. The company and its peers see a total addressable market for space-based connectivity and orbital infrastructure that could reach tens of trillions of dollars, while new heavy-lift launch vehicles from SpaceX and Blue Origin aim to cut costs and enable hundreds of thousands of satellites and orbital data centers over time. The consumer side of the economy is adding its own layer of resilience. Physical store visits across retail formats are running at record levels. Restaurant and retail spending have exceeded earlier expectations, and general merchandise categories such as fashion and home goods have gained share, helped by recent tax refunds, even if that boost may fade in the coming quarter. Large retailers including Walmart, Amazon, and Costco are gaining grocery share by leveraging technology and logistics, with Walmart in particular using AI to drive efficiency and incremental revenue without significant headcount cuts. There is also growing optimism around real estate and industry in the Great Lakes and Heartland regions, where abundant water, milder weather, and engineering talent are seen as drawing activity away from traditional coastal hubs. All of this growth, however, comes with heavy funding requirements. Rising government deficits, combined with vast private capital needs for AI, space, and energy infrastructure, are increasing the supply of bonds and helping to push yields higher. Recent yield moves are being linked not only to inflation, but also to this surge in demand for capital, challenging the view that rates will settle quickly back to low levels. Innovations such as tokenization promise more efficient credit formation and yield discovery, which could support capital productivity, but the near-term risk remains that multiple large projects and IPOs compete for a finite pool of funding. The counterpoint is that much of the transformative impact is still ahead, which leaves room for upside surprises as well as disappointment. Only a fraction of the projected multi-trillion-dollar AI spend has occurred, and companies like SpaceX have a track record of meeting ambitious milestones faster than skeptics expect, while quantum grants and defense-related AI deployments are accelerating timelines for commercialization. At the same time, corporate experience so far often points to incremental rather than revolutionary efficiency gains, and infrastructure bottlenecks in power and construction are slowing some data center projects. From here, investors are likely to watch consumer sentiment releases, further AI capex announcements, progress on launch and quantum programs, and the path of bond yields as key indicators of whether this growth impulse can be sustained without triggering a sharper repricing of risk. That brings us back to the central tension between powerful secular growth stories and the financial conditions needed to support them. To wrap up, AI remains the dominant force tying together earnings, macro, and positioning. The technology itself is moving from promise to execution, with massive capital spending, early productivity gains, and a looming wave of mega IPOs all shaping how risk is priced. In equities, tech leadership is still supported by strong fundamentals, but faces a higher bar, more selective winners, and growing concentration and liquidity risks. In the real economy, AI, space, quantum, and select consumer and regional stories are driving solid growth, even as they push up capital needs and keep yields under pressure. Watching how these themes interact across earnings, bond markets, and upcoming data will be critical for framing scenarios and risk budgets in the weeks ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.